Hey everybody, welcome back to my channel. So the producer price index came out this morning and it was bad. It was, if you can believe it, it was even worse than the CPI, which jumped by a whopping 0.9% last month. But producer prices came out today. They jumped by 1.8%, which was a little bit cooler than last month's jump of 3.5%. But final demand numbers came out. They were just an eye-popping, whopping 1% jump month over month. Producer price inflation now is 19.5% year over year. The CPI is at 5.3%. And unfortunately here, based off of this trend and correlation between producer prices and consumer prices, is definitely pointing to that the consumer prices are lagging a little bit and probably will catch up and shoot up above 6%, just like what the final demand numbers were pointing to that I covered in a vid yesterday. So here's what the outlook is looking like for producer prices for the end of the year. Before, I was saying that looked like producer prices were going to top off around 22.5, maybe 23%. Well, that's out of the way now. We're now looking at almost 24% price inflation by the end of the year for producer prices. And of course, as I've told you before, the relationship between the PPI and the CPI is roughly 1/3 when the PPI is peaking, so that's going to translate to about an 8% potential price inflation by the end of this year, and definitely that's a definite possibility. So going off of that and pressing forward, the final demand goods, prices, and services are now pointing to a 5.7% year over year CPI inflation. So this is the same model that I used a week ago, that I was showing you a week ago in an earlier vid, that I used to predict that 5.2% year over year price inflation. Of course, CPI came out at 5.3, so it was very, very close. And for the last 4 months, it has been almost dead on. 2 months out of the 4 months, it's been just spotless, just unbelievable how accurate it's been. And of course, it was dead on again this time. It looks like it'll be dead on again next time. So for next month's CPI, when the July numbers come out in August, we're looking at 5.7% year over year growth. And just tracking that downward and assuming that it's going to connect to that producer price inflation and catch up to it, definitely looking like we're going to have very, very high price inflation. This is certainly going to be bearish on stocks and bonds, particularly stocks. Bonds eventually, as investors are forced to admit that the Fed's narrative of transitory inflation is just false. So, this is driven mostly by money and debt coming into the system, as I've covered in previous vids. This was going to be said that nobody saw this coming or this was unexpected. It's a shame when a random guy on YouTube can predict what the inflation rate is going to be more accurately than the best and brightest economic minds inside of the United States. That just tells you how incompetent they are, or it could be a sign that they are being malicious and are actually being deceitful and lying. Maybe they don't want to, spur mass panic, and they secretly know the truth, that these things are not going to be so transitory after all. The Fed was forced to admit today, through Jerome Powell, that these transitory inflation numbers are going to be lasting around a little bit longer than what they originally said, and that they were pushing higher. So, they're already walking back that narrative. They're trying to still keep on that transitory story, but eventually it's going to get very old very fast. And I'm going to cover that in another vid of when I think stocks are going to peak and why, and show you the kind of flow of funds, so to say, about what stocks are doing. It's not just that stocks are just this aggregate magical number that's going to just drop one day. There's going to be certain areas of the stock market that fails first, then cascade into other areas before it results in a total failure. So, and usually these days you can carve out the stock market by sectors, but I'm not really going to do it in sectors. I'm just going to do it in certain of general area and classes of stock. So very broad based, because that tends to follow a sequential pattern with each bear market in the stock market. So that's probably going to be in the next video. So just to give you a recap, I said yesterday that stocks were probably going to continue on their downward trend that they did yesterday, and that's pretty much about what happened. So, you know, the Wilshire 5000 just dropped very, very slightly from yesterday. It kind of pushed upward early this morning. Maybe investors were going to be bullish about Jerome Powell going before Congress, as he was going to sue. That Powell was a little bit more candid about the seriousness of the nature of the inflation than he had been previous, and that's sort of put a bearish tone on stocks. It didn't help matters that bank earnings were not exactly exemplary. They weren't awful. You know, what Wells Fargo certainly beat expectations, but you know, others such as Citigroup just were kind of lackluster. One of the things I want to point out to you, though, and this is kind of giving you a taste of what to expect in tomorrow's video, is that the Russell 2000 sort of has dropped. Okay, so over the last 5 days, look at what's happened with the Russell 2000. It was at 2280, and it's dropped all the way down to 2202. That's a 3.5% drop in 2 days. So that's definitely coming from these inflation numbers, as stocks are already beginning to drop right now. It's just not being shown in the Dow Jones and the S&P 500 quite yet, and I'll go into that in a little bit. Meantime, though, the NASDAQ is also been, you know, is been flat. So, you know, when the inflation numbers came out yesterday morning, it definitely dropped a little bit, kind of recovered its positions, and now it's, you know, just staying flat. That's basically it, and that's pretty much been the same with the Dow Jones and the S&P 500. So if you were wondering, it's like, well, why are stocks continuing to press up with bad inflation? Yeah, on a nominal terms, they're pressing up, but they're very weakly pressing up. So it's not; these are not strong growth numbers, not by any means. Okay, they're very weakly pushing up, and that tells you that investors are getting jittery. The tides are about to turn, and I believe that the stock market will soon peak, probably within the next month. And I'll go into that in a future video about that. That's going to be very interesting to talk about. One thing about the bonds is that bonds sort of retraced. So after bond interest rates spiked yesterday from the inflation numbers, they retraced. Now, this had to do with Powell's testimony, because Powell basically said they're not even thinking about raising interest rates, nor are they thinking about tapering asset purchases of bonds. So that pushed those bonds back down. You know, the Powell administration is just basically still putting their foot on the gas. But as I pointed out earlier, that's going to inflate those CPI numbers even more as the money supply continues to grow. And it's been growing at very, very high rates now, going on, you know, the better part of a year. Okay, so the better part of the year, you know, the money supply numbers have been averaging at just over 1% per month. That's incredible, because that's basically 10 to 15% monetary inflation per year. And since there's a direct correlation between that and the CPI right there, it's just going to keep those CPI numbers elevated. So we're not looking at this calming down. Best case scenario, after we catch back up to the CPI, we'll have an average inflation rate of 4.5 to 5%, assuming a stable and high confidence in the US dollar, which I don't really see as transpiring, because there are other, you know, precarious effects that are forcing prices upward. So there's no surprise there that there are other, you know, outside effects. You know, part of this was the shutdowns, the freight costs that has been increasing, the shortages in certain raw materials and goods, the huge increase in commodity prices, you know, the chip shortage, all of those things. But at the core of this, monetary inflation has made this situation worse, not better. By propping up artificial demand, it has exacerbated those shortages, and it's actually made those shortages worse than what they are, as modern economists today are still operating by the failed Keynesian narrative that demand drives supply. They have forgotten that Say's law is true. Actually, they just don't believe it, and they're about to be proven wrong. Unfortunately, the proof to be wrong is going to have terrible consequences for the regular people of the United States and the world who don't really pay attention to economics. They see it in secondary terms, and as far as what they buy at the grocery store and supermarket, but they don't necessarily understand why these things are taking place, or even if they understand the very general aspects of it, they don't understand why it's happening now. And quite frankly, it's very, very saddening to see this, because we've placed a lot of trust, misplaced trust, I should say, in our federal authorities, and they are really, really botching this up. They're devaluing our currency. This trend is going to continue, and now the illusory wealth gains that we were seeing in the stock market are about to come to an end. In the meantime, what's been going on is that gold and silver have finally pressed up. So silver was flat yesterday, so was gold. It's as if the gold and silver markets were asleep at the wheel, just like the stocks were yesterday. But suddenly today they decided to wake up. You can see how silver and gold both pressed up by 1%. This just in one day, and I'm not saying that this trend will continue and like silver is just going to go up and up, and gold's going to go up. But I will do a forecast on gold in the coming days, as well as a silver comparison to gold, and a silver forecast in some future vids of where it's going to go. Essentially speaking, as stocks are going to be dragged downward, gold is going and silver will be dragged upward. It's not going to be something where you're going to see these skyrocketing precious metals effects right away. Instead, it's going to be just this slow pushing up. It's almost going to be painful to watch, but there will be some returns that are eked out, especially in the gold markets, followed closely behind by silver. So, but as I've said before in a couple of earlier vids that I've covered about analyzing gold and valuing gold, the bull market has not begun on this precious metals market, okay? So when the panic starts to really set in and investors start dumping stocks and bonds in massive quantities, that's when your bull market in gold and silver will stay in. One other interesting thing to note is that Bitcoin has largely just been a dud in the face of rising inflation. Now, Bitcoin's kind of retraced back up to 33,000, but it dropped down to below 32,000 yesterday when the inflation numbers came out, or very early this morning. So, Bitcoin has often been looked at as being maybe a digital hedge against inflation. That doesn't really seem to be the case right now. Bitcoin has, ever since it peaked in April, and this is coincidentally when the inflation numbers started to pop off well over 3% year over year, Bitcoin's kind of been in a downward trend. I'm not here to smash on the Bitcoin lovers or anything, but it does not really seem to be a hedge to gold. Instead, it seems to be following more of a speculative asset, and it really functions more as a financial asset similar to stocks right now. But that doesn't mean that Bitcoin is just going to crumble away into nothing. Bitcoin has been incredibly unstable, and when it has gone into a bull market, it has issued multi-bagging gains. So people who have tried to short Bitcoin have lost money big time, and people who have gone long on Bitcoin have made tons of their wealth depending on when they bought the coin. Now, if they bought cryptos at their peaks, they've lost a ton as well. So, we're really going into uncharted territories in the sense that the investors of today were not old enough to be, most of them anyway, to be involved in the markets of the 1970s. In the 1970s, this is something about our young crowds, and myself included. I wasn't old enough to go in the 1970s. I wasn't even born yet. But that was a different time, and that was a different sediment that's going to take over. Once that bearish sediment takes over, it's really hard to reverse. And that's one of the reasons why it is so stubborn to go into that sediment now. It's been bullish on stocks for 40 years. 40 years stocks have been your money makers. Okay, for 40 years, bonds have been your money makers. It's not just going to reverse because of one or two times of bad news. It has to get really bad before it's a wake-up call to Alice in Wonderland that it's all a dream. So take that for what it's worth right now. But yeah, the CPI numbers are just going to continue to press up as our monetary and fiscal authorities have not learned the lesson that when you have more money chasing the same amount of goods or fewer goods, it's going to push up the prices. So definitely we're going to see higher prices. Looking like the inflation, the CPI inflation number is going to press forward to 6% year over year. And definitely hit that when in September when the August numbers come out. So now, taking a look at the long-term CPI here, let's take a look at the 2-year trend right here. So the CPI right now stands at 5.3%. Your core inflation's at 4.5%. So it's lagging behind that overall CPI, telling you that food and gas has been outpacing core inflation a little bit. But still, core inflation's been pressing up, and the way it's been charted out, it looks like it's going to be pressing up along with this general CPI. But looking at the 2-year, you can see right now that we finally reached that 3% threshold. And if you remember from an earlier vid when I was talking about how we could be going through another 1974 event, when the CPI reaches about 3.5% or above, that seems to signal a peak in stocks. And it looks like we're going to hit that in August. So, you know, we could hit it in July if the numbers come out a little bit worse than what I projected when July's numbers come out in early August. But it looks like August's numbers, when they come out in September, is going to signal the final peak as long as this trend continues. So just keep an eye out for that. And I'm going to give you guys another analysis, general overview of the stock market, just looking at the different stock index funds that we use right now to gauge stock market performance, and kind of show you a few patterns that are interesting that could help you help signal to you that the bull market is about to end and that the bear market is about to begin. So stay tuned for that in the vids. I'll put those out as soon as I can. But yeah, it'll probably come out tomorrow evening. So just keep an eye out for that, and I'll keep you guys posted. Until then, guys, stay safe. And by all means, if you're trying to protect yourself, if you're trying to protect your assets and wealth, gold and silver right now is on discount price. So just, you know, keep on purchasing those, holding those, and you may want to consider rotating your money out of stocks and bonds right now, because the heyday of the stock market is about to come to an end.